Right, so that should bring us into the presentation now. So what we're going to do is cover off sort of specifically what's happened in the purchase market, really sort of since lockdown and sort of where we are sort of post-COVID. So as I say, any sort of questions, feel free to type them up in the little chat box and we'll pick that up at the end. Because I can't see what's been in the presentation, but hopefully I should answer most questions. But what I've got to cover off should take about sort of 20-25 minutes. Then I've got sort of obviously then 10 minutes for Q&A, but I've really got as long as you need. So if there's more questions, great, I'm happy to hang around. Because there's a bit of a mix of people on this call, there's some people that have worked with us previously, some people that haven't. So just by way of a very, very quick introduction, we are mortgage brokers and we have pretty much unrivaled access to the market. In good times, to give you some numbers, there's roughly about 100 lenders with 17,000 products. Probably all those lenders around, no one's sort of no one's bowed out the market so far, but there's far less choice, probably around sort of 10, 12,000 products, something like that. Reasons for which we'll explore in a moment. So hopefully if you are looking at buying your first purchase or sort of moving, I would be very surprised if we can't help anyone. But this is sort of really just to bring you up to speed as to where we are, and we finish off with some specifics at the end. So if we dive into that now then. So that's us. These are all our sort of contact details. So what we're going to cover off today is really around purchasing. So I'll go through the sort of a couple of statements at the top there. So with first-time buyers and new purchases, we can deal with it together because there's sort of sometimes a bit of a myth that first-time buyers are dealt with differently from new purchases. They're actually not. There was a bit of regulation a few years ago, which I won't go into now, but the point of it being is that every time you come to get a new mortgage, whether you're refinancing, moving, or whatever you're doing, you're treated all the same, which is actually really positive. So there's no disadvantage or advantage for being a seasoned veteran or completely new into it. And I'll go through sort of roughly how it works. The subheader I've got is how to get debt-free faster, which might seem really weird, particularly if you're buying for the first time, about to be saddled with the biggest debt you're probably ever going to have in your life. But there are some really good principles that we want to play with, and for me, it's really being a broker is about managing debt down and putting more money in your pocket and not in the bank's. So even though if it's the first time you're doing this or looking at increasing the debt you're taking heavily, you know, really, we've got to have an eye on how we manage that down. And there's a couple of things we'll pick on as we go through. So the main thing I want to focus on is sort of what's happened in the market, what's possible, what's not, and there's a couple of themes that have come out obviously over the last couple of weeks. Very closely linked to that is what you can do to improve your credit score and get yourself in really good shape when you come to move. How you can borrow it and how your income's assessed, which really should be taken in tandem with how to navigate the market if you've got a complex income. I'll come on to that. We might spend a little bit more time on that because it's very different now as it was even a few months ago, and we'll explore that. And then as I sort of finished off, it's how you can save tens of thousands of pounds over the lifetime of the mortgage. So it's all well and good taking a big mortgage, and everyone likes the term mortgage. It's warm, fuzzy, it's at home, it's cool. The reality is it's a very big debt. So sorry to start on a negative, but it just is. That's not a problem at all, but it's just how you manage that. And as I say, I'm very passionate about saving you guys as much money as possible. And then a sort of footnote really is sort of to be how you can be independently wealthy come retirement. So the word wealthy has a few different connotations. To me, it simply means having more than you need. So, for example, if you need £2,000 to get through a month, as long as you've got £2,001 a month coming in, you're in great shape. It's not about being a millionaire or billionaire or anything crazy. It's just getting normal people in good shape so you don't have to work well into retirement or, again, be saddled with a big debt for a long time. So saying 3 easy steps is one of those sort of very online shyster sort of comments, which it's really not. They're very easy steps, but they're very difficult to do. And if anyone's done any sort of basic financial planning, it's just the real basics, but I don't think it's really touched on enough. So that brings us to today. So where are we with the market? So probably the biggest change we've experienced over the last few weeks and months was surveyors being off the road. Now, naturally, that has a really big impact on mortgages because, you know, surveyors are a bank's eyes is the best way to sort of introduce that. So, you know, a surveyor will go to a property and think with all their experience, you know, is the property worth what you think it's worth? So it's actually just as much in your interest when you're buying as a bank to make sure you're paying the correct valuation. So are you paying too much? No one ever pays too little in London. I don't think I've ever seen that. So that was really the big thing. As we sort of came into lockdown, pretty much everything ground to halt for a couple of weeks. But really within, I would say within about sort of 2 weeks, 10 days, there are a number of lenders that pushed out what they call their AVMs into the purchase market. So let me explain that. An AVM is what's called an automated valuation model. So when you come to remortgage a property, you might see there's often a free survey attached, and there often is with purchases these days. But what banks do when you come to refinance a property is, if you bought your property 2 years ago and you paid X, and house prices have gone up by 2% in that time, they know your property's worth Y. It's pretty straightforward. So that indexing or AVMs, or sometimes called desktop valuation, basically an online model that banks use, has been around for a very, very long time. Sometimes they do use it with purchases. So if you're putting down a big deposit, a bank will just say, yeah, actually, we know roughly what that property is worth for the same reasons. You're putting down a big deposit, it's enough security for us to lend. So it did happen occasionally in the purchase market, but it was rare. And then obviously then the whole world changed. And then we sort of get to a point where 2 weeks into lockdown, everything is done online. And me, like some others, were really staggered at how well that went. And again, if you take the principle, if you know what a property was bought for when, how much house prices have changed in that time, banks have a pretty good guide. The only time it doesn't really work is if someone's done extensive work to a property or modernised it, or added some, a loft or an extension, that sort of thing. But barring those circumstances, banks are pretty comfortable. And as you can see here, sort of with what's possible. So this is what's possible today. But even through sort of the depths of sort of lockdown. Now, it wasn't quite as generous as it. In fact, I had to update this slide this morning because some banks have been a bit more generous on the 85% mark. So you can see, whatever level of deposit you have or you're looking at using, even using a 5% deposit up to £500,000 is phenomenally generous. I'm quite surprised that banks have still stayed in that space. And this is with automated models. Now, surveyors are allowed back out on the road now, so you'd expect that to ease up, and that's why things are loosening up. But it really didn't dip down much. Obviously, once you go into a big sort of shock that happens to the economy like that, obviously things sort of stood still a bit. But we've seen very few people back out of sales. We've seen a lot of people agree new deals, and it's still really, really generous. So that was sort of really the big thing, and probably the big thing to push upon to you is that this is here to stay. So you may not get a surveyor going out to the property if the figure doesn't come back to what we want, or typically if you have a high value property, or it's unusual, maybe it's listed, or unusual construction like a sort of thatched cottage or something like that, what I'm dealing with at the minute. Then naturally a surveyor's going to go around and check it out. But I've spoken to quite a lot of the big banks, and they really want to keep this because, one, they have a lot of faith in their model, and two, obviously it saves them a lot of money and it's a lot quicker for you guys. So I think that's a real positive that's here to stay. So there's sort of the maximums. Now, naturally, you're not all going to do that, and you may not want to push things that far. All I'd say is a couple of little caveats is that you may not get up to that sort of level based on your circumstance, or also, if you want interest only as a factor in the loan. Some banks, typically offer, want to see around a 25% deposit if you want interest only. And again, that's not true. Some banks are more generous than that, but that's sort of a general rule. That 25% figure, as you can see there, if anyone's planning a big purchase coming up, great, you've got that much money and got that much income, more likely to support it. But the 25% figure is always sort of the magic number in terms of mortgages, because house prices have never gone down by more than 25% in any cycle. And I think I've got some figures we're going to talk about a bit more specifically as to where we are right now. So that's why that magic number is there for mortgages, because it's the bank's risk. So they know if you're putting down 25% deposit or more, really they're not going to lose their money should they need to repossess you. So not risk on you, it's risk on the bank, that one. But I've been staggered at how well that's gone. And this is, I hear the phrase a lot, the new norm, it's called change, but this has changed and this is here to stay. Now, have lenders been defensive in their criteria? So as I sort of say, yes and no. If I sort of think about my own personal experiences with my clients I've been dealing with over the last sort of few months, I've not had to say no to anyone, which I'm actually quite surprised about, because I was expecting more banks to be more defensive than they were. The reality is banks have got a lot of money to lend, and they're just not lending it enough. So what makes a lot of press is obviously like if Barclays pull out of something, or HSBC change something, okay, that makes good head, and everyone starts thinking a bit negatively. But from our point of view as a broker, it doesn't actually matter. If two banks drop out of a certain sector and we still have 15 that are doing something, well, I don't really care. It just means we don't use that bank, we go to this bank. So as far as I'm concerned on the market level, there's really very little that's changed. So a lot of banks haven't changed their criteria. Something we talk about a bit more about specifics of complex incomes is, there's more questions asked. You need to think about it a bit more. But again, like the valuation thing, I've been really, really impressed at how banks are sort of looking at things in a very logical way. And these things are sort of self-fulfilling. So, are you going to come to move right now if you lost your job? You're probably not. I mentioned furlough down there, so if your income's reduced, okay, and it still works to what you want to do, great. If the furlough income works, and I've seen lots of sort of variants around this. Some people are getting furlough, some people have got extra money from their company, and some people have taken reduced income. So there's all sorts of variants around this. So the bottom line is, if your income has reduced or you've been furloughed, so whatever you're earning right now, a bank will assess that as income. They're not going to sort of disadvantage you for it. So again, you can still do that. It's not a problem, but obviously we need to look at what the income is now. Now clearly, if you're earning very high sums before and you're not now, that might debilitate what you want to do. So that's why it does become quite self-fulfilling, because you'll simply wait until things recover. But just to sort of put your mind at rest, things really haven't been as bad as we think. Again, a lot of headlines are there, sort of the clickbait these days. It's not headlines really, it's far more online. But it gets a lot of clicks going with disaster. The reality is it's been really, really good through this period. Next to that, this wants to work. Sorry, there we go. Is really the big question mark was really around house prices. And probably the number one conversation I've had this week is, existing clients of ours sort of saying, well, should I renegotiate a price, or how much should I offer? So what goes on the asking price? Now, that's never a conversation I'm going to have or give you an advice on. It just doesn't work. London's way too complex and big. I have no idea what's going on in different areas. So what I tend to do is work on sort of much higher level principles. So one thing I look at a lot is RICS, which is the Royal Institute of Chartered Surveyors. They survey all their members every month. Now, obviously, going into April, we're sort of full lockdown with no end in sight. There's no surprise that some of these figures are quite pessimistic, so do take it with a pinch of salt. But it does give you a bit of a feel as to, the people who are, I mentioned about AVMs, these automated models. Now, behind that are surveyors plugging in their expectations as well, so humans are playing an aspect in that. Really, out of these stats, the key one for me was 40% of people believe prices will come down 4%. Which is pretty much in line with what we're seeing, is people are sort of agreeing about sort of 5% off whatever they were. So this goes back to, so there's two aspects of this. One is, if you've got a sale going through, should you renegotiate the price? That's a really difficult thing. I spoke to someone who agreed a deal in December, and a lot's changed. So is there a valid conversation to be had there? Potentially, but the vendor doesn't have to accept that. They could sort of say, well, actually, no, I don't want to renegotiate the price. And you've got to think if you're buying and selling in this market as well, because if you're doing that to someone that you're buying from, they're probably going to do it when you sell. So a lot of this stuff is sort of self-fulfilling. Where this does become quite an opportunity is obviously if you're buying for the first time, or you don't own a property currently. So that's what's happening specifically on prices. There's then a whole different conversation around list prices. So the prices you see on Zoopla, Rightmove, etc. What we were seeing pre-COVID was people were getting really close to asking price, if not over in some instances. So prices were pretty firm. What we're seeing at the minute is people are going for that sort of 5 to 10% off the list price, which is different from an agreed sale. So that gap is now sort of bigger. So you might sort of be looking online thinking, well, prices haven't come down at all. Well, you'll probably find they're a lot softer than they were before. So people are probably far more willing to take a view on it, because look, these are the guys surveying property. These are what their views are. And the reality is, it's going to take time. The press, particularly in the last 24 hours, is sort of showing about the economic impact of what's happened. I think I saw, if I remember this correctly this morning, that the government borrowed 6 times the amount they were planning to in April than they were planning to borrow for the entire year. It puts that in sort of context as to how much debt everyone's taking on. So, that's why RICS think it could take 11 months for prices to recover from where we are now. So certainly if you're looking at moving, it's a great opportunity. And if you're upsizing as well, okay, 4% off your property is not great. But then if you're making a big purchase up, 4% in pounds terms on the next one you're buying could be quite a good saving. So, I can't tell you what to do, and I can't give you any more guidance around that, because everything's very specific. One seller might just hold out for their life of the price to sell. Other people need to move and take a view. So the only point to this really is, take the price you see online or when you speak to agents as more of a guide. I think that's a lot softer than it was a few months back, which is sort of stating the obvious. Another big conversation is, people are seeing interest rates sort of cut down a lot over the last couple of months, and I'm going to talk about this in detail at the end, so I'm not going to touch on it now, but a very blunt answer is, have mortgage rates come down? The honest answer is no. They're just starting to nudge down now. The reason why they haven't gone down as much is sort of twofold. Is one, that banks don't really have the capacity to do the lending that they were doing previously. So what would normally happen if interest rates fall, banks lower their interest rates, and then they sort of carry on. What a lot of banks have done is deliberately kept their rates high because they can't process all the applications. So it's been a bit of a game recently in terms of who's the cheapest lender and pulling away from that position. Now, literally in the last week, that game started to turn on its head now, as banks have got people working from home and adjusted to this new normal, certainly the situation for a while yet. So their capacity is up, they want to lend more, now rates are going back down again. Now, we're talking 0.1, 0.2, this is very, very small moves, but you know, the trend is definitely back down again. My little crystal ball thing here is that I do think that rates will sort of drop around Q4 this year. Now, it's for all those reasons that you might find that once the capacity is up, we go back to norm, we sort of get rid of this virus or find a vaccine or whatever the outcome is, and things start getting a little clearer. You're going to get to the latter half of this year where banks are going to miss their targets by a long way, by quite a long way. And the only way they can make that up is by buying new business in, when you know the thing that banks do is they cut their mortgage rates. So one thing I would sort of think about, if you're sort of moving, you have to move ahead of time. One thing I would seriously consider at this state in time is thinking about taking a penalty-free deal. Because obviously, if you can secure a property for 5, 10, 15% below the asking price, well, that outweighs any saving you're going to get on a mortgage. So it's worth doing it for that purpose. But why not entertain taking a penalty-free deal? So if rates do dip at the end of this year, beginning of next, you could flip out of the deal you got to buy the property and then maybe take something longer term. We'll touch on this in more detail at the end, but that's just a sort of an idea that we're talking to a lot of people right now and we get it, and we're arranging a lot of penalty-free deals for that very purpose. Another question I get asked a lot is that when things going back to normal, you know, little sort of jibe at the government there, you know, sort of with their clear guidance. Now, I'm not. It's easy sort of to dig at them because they've got a hell of a job now. We're seeing now how complicated it is to unpick the situation we're in. So I don't really envy them, but I don't think we're going to see normal again. You know, I think meetings like this are going to become far more common. You know, my guys are working from the only one in my nice office, which is quite good. You don't get pestered. But, you know, it's going to be very, very different. I mentioned about the surveys being different. There's things that are going to be very, very different going forward. So I don't think we're going to go back to normal. But certainly in terms of lending policy, you know, I'll go back to that Q4 thing. So once banks are back, they've got money. You know, it's not like 2008. In 2008, the issue was banks had no money. And if you're a bank with no money, that's a problem. The problem we've got now is capacity. So they simply can't get the staff to do what they need to do. Surveyors haven't been out on the road. That whole sort of property chain has sort of fallen down again. But now that stages are back at work, surveyors are back at work, people getting working, it's going to sort of put itself back together again. Another point there is like ultimately everything's cyclical. So what we're seeing right now is banks are tighter. There's no denying that, and we can talk about that a bit more detail in a moment. But you know, I've done this now. I mean, sadly, I started in mortgages in 1999, and I've seen most cycles by this point. And you know, 99 through to 2007, we just saw policy relax till it created a bubble and it popped. You know, that hasn't really happened in the last, well, so 2007 was the last big one when it started, and 2009 was when it really bit. Since then, we've had Brexit's put a break on the market. Now we've had this. So those sort of cyclical elements have happened, not through finance. So what I suspect you'll see is once we get through this, you'll see policy tightening, loan to values increase, all that sort of stuff, building up to the next bust, just to fill on a sort of nice point there. But unfortunately, if you read any Adam Smith, you'll realise it is quite inevitable. But the point to that being is that because of what's happened, such a big correction, I think we've got a good 5, 10, maybe even a 15-year run once this is out the way. So people are just, human nature, it's just natural that you're all very affected by recent events. So a lot of people are thinking negatively, think, oh, I don't want to buy now, I'm not sure what's happening with my job, this, that and the other. But on the basis of you have a stable job and you can move, I personally think right now is a superb time to move. I'm actually doing it myself personally. I mean, and again, I'm a good example because, you know, I want to get my kids into a better school. We want to make that big move, that big last move. You know, it's not a bad time for that. So I don't think we're going to see these conditions for a good while. Just we've had so many knocks in the market. So just something to think about for the longer term. Right, just something I'm going to sort of, the next couple of points I'm going to sort of go through relatively quickly because I've talked for far too long on those, but sorry, that's sort of where we're at. But what you can do to improve your credit score. So I'm just going to sort of spit these ones out quite quickly. The first thing, particularly in London, is your address history is key. If you aren't signed up to a credit check, and I'll share one after this, a free one you can go on to, please do look at your addresses. I remember when I first moved back into London, I think I lived in 3 different places in 3 years. We're all flats and all the addresses formats were all different. And this is the #1 way where you get declined for a mortgage because just simply your address format doesn't tally. So we'll sort of type in what's in your bank statement into a bank system, but actually on your credit file, it's formatted completely differently. Once you log in and check, you'll see. And if you need some help on that, me or one of the team can help you through it. But that's the #1 reason why you might get declined for a mortgage when there's nothing wrong. And it's a real London issue, particularly around flats and formats of addresses is a big one. Obvious statement, but I'll make it anyway. Repay your debts in full each month. So if you've got a credit card, pay it off. If you've got a loan, make sure it's all paid up. Obvious stuff. This is a bit of a footnote. This still isn't sort of common knowledge, but with payday loans, just so you know, the criteria around this is that if you've taken a payday loan in the last 12 months, all high street banks will decline you for a mortgage. Now, you can say whether that's fair or not, and there's also that market's sort of really debilitated now anyway, but that was becoming quite common practice. People were doing it, and they just didn't understand the connotations. You think, well, what's the problem? I'm taking a loan, I paid it back. The banks, as you can imagine, banks are very risk averse. They think about financial management, so that's why they don't like that. So just be aware of that. If you've had to recently, fine, but that's sort of the situation. If you have, talked to us. There are ways around it, but you find most of the high street lenders are really, really negative on that one thing. Don't have too much open credit. So what banks get nervous about, let's say, for example, you've got 10 credit cards, all with a £10,000 limit, but with a zero balance. You think, well, I'm managing my affairs correctly. But a bank could be really worried. You take a loan with them, particularly if you move, and then you rack up all those credit cards, you've got 100 grand's worth of debt, which then makes the loan unaffordable. So that can go against you in terms of a mortgage credit rating that wouldn't necessarily show on your credit file. Same reason, for the same principle, if you apply for a lot of credit in a short space of time, banks get very nervous for that very reason. Occupation is a huge factor, so this happens a lot, and I think this is a real aspect going forward. Is occupation that banks like are the traditional professions, doctor, dentist, lawyers, accountants, teachers, all these sorts of guys, because they're pretty much recession proof and pandemic proof in this time. So that's why they like that. Say for example, I'll pick an example of a good friend of mine. He runs a company that does hospitality. So what you might find is that if you work in that sector, banks may then dial down their credit score because they may not want to be exposed to that right now. Banks are a lot cuter in how they manage their credit scores than they ever used to be. So just be aware of that. If we go to a bank and you get declined, it may be nothing to do with you. So we start with lender A, you get declined, you go to lender B, you get approved. People often worry about, what if I get declined for a loan? It doesn't show on your credit report. Most banks don't even show that had a look at your credit file. So it's all very damage free. Banks understand the risk profiles are different, but just so you know, your occupation is a huge factor in terms of getting to a mortgage, which won't necessarily show on your credit file. So that's sort of what constitutes your credit score, but why your credit score exists. And if you look at this with your Experian Equifax model, there's loads you can look at these days. When you log in online, what you see is compare mortgage, compare loan, compare credit card. So the credit score they give you is how much you think you can click onto those ancillary partners and be approved for those loans that they get paid for. So that's their business model. So just so you know, if anyone's seen The Big Short, how data's, sorry, not The Big Short, is it The Great Hack? Where it shows you how Facebook uses data, etc. It's all about data and how it's used and how it's monetized. So do take your credit score with a pinch of salt. I've seen people with very low credit scores be approved for a mortgage. I've seen people with very high credit scores be declined for a mortgage. You have to get into the detail and some of these factors of what we've touched on. But again, if you're having problems, we can help you through it. So how much can you borrow? Always sort of the golden question. The sort of a simplistic way around this is, and I won't go into it now because it's a bit short on time, but just at high level is that you can borrow around about 4.5 times your income, less any commitments. So let's pick some round figures. For example, for me, my daughter's at nursery, that costs £1,500 a month. You times up 1,500 times 12, you take that off my income, and then you times that by 4.5, and that's roughly what you can borrow. If there's two of you, then the same process applies. So it's no different. So you take both of your incomes, you take off your outgoings, and you times it by about that. The maximum you can borrow is about 6 times your income, which is still standing at the moment. And most of the big banks go to around about 5 times your income. So it's around that sort of 4.5, 5 times is roughly what you can borrow. You can go to 6 as a maximum. Now, the huge caveat on all of this, so the big asterisk I put on this, if any of you listen to Costello and Bunt's podcast, which is excellent, by the way, so I'm a big boxing fan, the big sort of Bunty asterisk on this one is what constitutes income is a big question. So if you've got a straight salary, that's really easy. Whereas if you've got bonus or commission or you're self-employed or you're a contractor, it's not as simple as that. So some banks, for example, take 100% of your bonus, some only take 50%, and there's lots of variance within that. Same thing with commission. Which is self-employed, even more complex still. Some banks only take your net profit, some only take your dividends, and some take your salary, and some take a combination of those factors. So what a bank constitutes as income can be different. So for example, a bank offering 4.5 times income but takes 100% of your bonus may offer you a bigger loan than someone who gives you 5 times income and it takes 50% of your bonus. I think you get the principle. So they're the sorts of things that we play around with to get you where you need to get to. Contractors, it's a bit more complex, but it gives you sort of quite a simple sort of calculation to work from. What most banks do in general terms is take your daily rate, times that by the days worked, and then times that by a 46-week year, because there'll be gaps in contracts or Christmas and holidays, that sort of stuff. So it'll be something like your day rate times 5 times 46 is roughly what a bank will use for assessment for your income. Now, I appreciate if you're a contractor, you probably run yourself through a limited company and you can get a mortgage as doing that as being self-employed, but you probably find that that calculation on your day rate is far more favourable because, you know, I run my own business and I run a lot of costs through my business. So actually, you know, my net profit comes right down, probably comes down quite a lot more at the minute. But, you know, you bring that down, because obviously you don't want to sort of pay much tax. So banks are aware of that, and contractors are sort of, they're halfway between being employed and self-employed. So, but that calculation is quite generous. As I mentioned, so normally I talk about this in detail. This is really a footnote at this stage because things have changed. What banks are doing is looking at things very specifically. I used the example of hospitality before. So, you know, what banks are going to look at is the viability of your income and your role going forward. Some banks aren't including any bonuses at all right now. Some are all of them. So this, I'd normally say that things that are sort of like complex are things for a startup, if you're self-employed, you know, all these sorts of things. And the trialities around that are like how much relevant experience have you got? What's your track record? You know, not all income's treated the same, you know, particularly with tech firms, for example, they pay a lot in stock options and vesting stock. People working in banking and finance, that they have a lot of carries or vesting stock schedules, that sort of thing. Not all banks take that as income. So like I say, at the moment, normally it's a case of like, you know, if you're in that world, then we have to take a bit more care. But I would really say at this moment in time, if you have any variable element to your income, I would treat that as complex if you need it. Now, obviously, if you can borrow the money you want to borrow for your basic salary, then cool. But most people, you know, have some variable element to their income, particularly if you're in London, particularly if you're a higher earner, it's quite common. So I would really say, please speak to us or quite frankly any advisor, but obviously we're the best. But, you know, do speak to an advisor, because it's just go to bank A and don't get the outcome you want doesn't mean we can't go to bank B and get what you want. And like we'll finish on with interest rates, everything is so cheap now, it doesn't really matter. You know, a difference of going between one bank and another could be 5, 10, 15 pounds a month difference. Like, are you going to miss that? You're really not. It's far more about getting the right amount of lending for the property you want to buy. Right, so I'll whistle through this one because I know we're sort of focused on purchasing, but this is a footnote and something to think about down the line. So this is a specific example of one of my clients I remortgaged the other day. So they had a mortgage about £500,000. And there's 28 years left. Obviously, they bought for the first time, and we did it over a 30-year term to make the lending more affordable, which is quite common. And they had a rate of 1.74%. So the monthly payments were about £1,880 a month. Now, standardly, you can refinance, keep the term over 28 years, get a much lower rate because rates have come down. And what happens often is when you buy a property, if you have a smaller deposit, what happens over time is you pay off the debt, and hopefully house prices will increase a bit in the longer term, not in the short term, but in the longer term. So often what you find is that you increase your equity as you go along, so you're less risk to a bank. So you often find the first mortgage you get when you move is the most expensive it will be for a while, and I'll touch on that in a bit more detail in a second. So nothing wrong with keeping the term the same, you reduce your outgoings, brilliant. I'm still paying the loan off, that's great. However, you know, one of our principles, as I said, is getting people sort of debt-free as soon as possible. What we would urge you to do at that point is actually keep your outgoings the same. So you could knock 2 years off the loan, so it's only £10 a month more, but that saves you over £11,000 over the term of the loan. So that is what we would think about going down the line, is if there is a reduction, don't necessarily take the reduction, because if you've used that money going out, then great. Also, you know, this is the point, you know, it puts money in your pocket, not the bank. And that's really what it's all about. Now, this is obvious if you say here, now, hopefully from this point on, you know, like I said, right now things are tough and things are a bit up in the air, but the reality is in longer term, incomes will go up, things will go back to normal. It just does, you know. There's generally a big pandemic about every 100 years, if you're interested, you know, look at the history of this. It is unfortunately normal. It's very unusual, but this is quite normal. So we will get through it, and it does go away. So what you find is that incomes will go up over time. Most people, when they're buying, it sort of happens, and generally as you go through your career, get more experience, you get paid more. That's generally what most people are gunning for anyway. So if in the intervening years between you buy now and actually your income's gone up, why not pay the debt off faster as you go? And I've given a really simple example there. Even knocking one extra year off the mortgage, instead of saving £11,000, that goes up to £25,000. Now that's really significant. You go through a few cycles of that. So you might start with a 30-year loan now to make the loan affordable. You know, again, I pick myself as example. I've got my daughter in nursery, as I mentioned. Now that's a very experienced son. She goes to school next year, thank God, because schooling's cheaper than nursery. And then obviously with all those reductions, I can then start knocking off £500, £1,000 more a month on my mortgage. So it's a life cycle thing. But this is very much what I said at the outset. It's about managing debt down and someone helping you manage the debt down. A bank's never going to tell you this. They go, oh, look, great news, you saved money. Oh, I've saved money, it's great. The reality is you'll spend that money. You just waste it. That's what happens. You spend what comes out of your bank account each month. That's just what happens. I know this is very boring, and I know I'm a boring financial advisor, but you know, you project those numbers forward, it can save you a hell of a lot of money. And that takes us nicely into sort of how you get independent, I should say financially independent, sort of reframe that if you don't like the word wealthy, you should say sort of financially independent. So these are 3 easy steps. There's a book I read years ago, which I love. It's called The Richest Man in Babylon. If any of you have got a bit of time on your hands, or you love a bit of reading, particularly if you like audio books, this is a real winner. It was written in about 1942, I believe, and it was written in very much King James Bible language. So if you like that sort of quite lyrical sort of language, it works really, really well. The point of the book is that Babylon was the first ever man-made city about 8,000 years ago, and they created money. And they translated all these tablets, these clay tablets they found, I think out near Babylon is where Iraq is now, I believe, or very close by. So they were sort of doing all this sort of stuff, and they're obviously translating all this stuff in the 40s, thinking it quite boring. But you can literally take the principles out of that book, and it's as true today as it was then. It's absolutely staggering. And this is sort of a, you know, this is out of an 8,000-year-old principle. And one of them was buy your own home, pay off the mortgage. Now, most people are comfortable with that one. Most people will be aware, sort of what they advise in the book is save 10% of your income for the long term. Now, most of you, you know, if you don't have one, or if you work for a company, you probably have a pension or something like that. Some of you may have a buy-to-let. That's a good way of doing things. But it's really, the point being is put a good slug aside and invest for the long term. You have to do that in tandem to paying off the debt. You have to do the two together. You can't just do one and then do the other, because it doesn't work. And the third principle is protect your income and assets through these 2 steps. I think the direct quote of the book is something like, if you don't insure against loss, you will suffer loss. It's as simple as that, because you could be 10 years down the path of paying off your 30-year mortgage, and God forbid one of you die, you know, get cancer, or you're off work. Like, I'm sorry to bring the tone down, but that's just the reality, and we deal with this day in, day out, we see it. One, that's the quickest way to lose your home, and it's the quickest way to put you in real financial dire straits. But you can insure against all of that stuff. So even if something really bad happens, you can pay off your mortgage, you can still saving, and you can not be financially disadvantaged, even though they're huge impacts on you. So please do read the book. It's a brilliant read. It's only a little book. It's brilliant. And there's lots of little bits and pieces in there that I think are fantastic. So there you go, 3 easy steps, but you have to do it for 25, 30 years. That's the kicker. But it is that simple. And how to manage debt. There's a great story in the book about debt, which I love, which I won't go into now because I'm short on time. But again, same principle. Even if you're in debt, still save 10%, pay 20% off to your debts, and live on the remaining 70. Read the story in the book because it's brilliant. I don't have time to go into it now, but I really, really do like that. Now, just to close off a bit on interest rates, because we're a mortgage broker, so we look at that. I use this slide. I'm sure most of you are avid readers of our email that goes out every week, but God forbid you're not. And if you don't, just so you know, I literally look at this every week. And please do look at our LinkedIn, which I think there's there we go, there's a link for that. I post this every week, and you see the changes, and hopefully you can see my cursor on here. So I want to get a really, really 2-minute sort of economics lesson. So what I look at a lot isn't so much the Bank of England base rate, which is this gold one here. Most people are sort of familiar with this. But what I look at far more so is either LIBOR here, which is silver line, which is the London interbank offer rate. So that's actually the rate at which banks borrow from each other, and specifically for mortgages 2- and 5-year swaps. So that's basically what 2- and 5-year fixed rates are funded from. So they're primarily the products that we arrange for our clients. Now, short economics lesson, if these lines are above this line, that's good, because what we're expecting is interest rates to go up, and that means GDP is going up, and that's all really good. Down here, obviously, if they're below this, it's bad, because what we're expecting is GDP to fall, the economy to be smaller. If you cast your mind back to this no-deal Brexit threat, which probably seems like a walk in the park compared to what we're dealing with now, you know, obviously very worried about that. That triggered another election. the Tories got in, and whatever your political leanings are, markets like certainty. So like, right, back on track for that. That's great. Obviously, through December and January, news starts coming out of China, and then that takes us through to where we are now, which doesn't take much explanation. So the closing point on this, as I mentioned at the outset about potentially taking sort of penalty-free deals, is, you know, if you look at the 5-year money here, it's stupid. It's never been so, like, never ever been so cheap. So the logic would be, well, let's take a 5-year fixed because it's the cheapest money you'll ever get. The reality is banks still pricing quite a premium. And I don't think interest rates are going to rise anytime soon. And that's also what this chart suggests, is that at the moment, and now bear in mind, you've seen the movements here, sometimes things don't, you can see the base rate doesn't always move in line with what markets expect. So this sort of movement's normal. But as we sit today, back markets are only expecting a 0.25% rise over the next 5 years. So I personally think that's quite pessimistic. I think people are in a very pessimistic mode. So that's why I think penalty-free deals and sort of like playing around with it a bit, you might sort of win from it. But that's what the market expectation is right now. So rates are staying very low for a very long time. That I'm pretty sure of, you know. And again, I mentioned before about how much debt the government's taken on. So, you know, our UK government's not on its own. Most Western economies have taken on phenomenal levels of debt. The only way you can pay that debt back is by keeping interest rates very low for a very long time. So that's personally why I think it's a great time to buy, because I think prices are soft, interest rates are low. You know, things will recover. You know, Rick's think over the next sort of 11 months or so, and then from there we should hopefully start getting back to business as usual. So this is looking like a year out, and then you move on. So I think in the next sort of 6-12 months, there's phenomenal opportunities to buy. So, well, that's my prediction for what it's worth. So you can find us through the website, through LinkedIn, like I mentioned before. But what I'll do is I will come out of this now and answer any questions you guys may have. So again, so if anyone's got any questions, feel free to type away in the little box there. It's got the little sort of square box. Unless I've done that so succinctly, I've answered everybody's questions, which I've been quite impressed with. So just give you guys a minute or two. No, well, I'll take that down as a winning performance then, if no one's got any questions. So, so what we'll do is wrap up then. So I'll email this round to everybody, so you've got the link to the presentation and also the credit report thing, so you can check that out. Also, oh, Rory, sorry, I can just see you've answered the question. So Rory said, you mentioned you are in the process of buying. If it's okay to ask, are you looking for a 2 or 5 year fixed or something different at the minute? No, fair question to ask, Rory. I'm looking at doing a 2-year deal. I'll probably even go variable, to be honest with you, because for this, so I never give advice I don't follow myself. That's one of those just golden rules for me. So I'm just going to see what money market, because for me, I don't have property in mind right now. So it might be that I find the right property for 6 months and I'll sort of see where we are. But I'm definitely going short term. And if I buy in the very near future, I'll probably go penalty free, because I do think prices will dip down the line. So I'm willing to send you the offer. I never give advice I wouldn't follow myself. Justine, what about 10? Oh, sorry. What about 10% deposit mortgages? So yeah, they're still available, as I mentioned. So generally, you can buy up to £500,000 with a 10% deposit. Previously, you could go up to about nearly £1 million with a 10% deposit, but for all the factors I mentioned, it's a bit restricted at the minute. So, but that is changing week on week. In fact, the lender coming back next week that does a 10% deposit up to 750,000, so that'll even improve next week. And then it's really that process I mentioned about sort of managing debt down. So even if that 10% mark, it's then every 2 years, bring it down, bring it down, bring it down, bring it down, just so you pay the whole thing off a lot faster. All of what is VW, but you've asked a question, with new developments where construction was delayed due to COVID, is there now a confirmation completion date? When would you advise looking to secure a help to buy loan? Well, if you're under offer, I would say apply now, just get that done. Banks have been really, really good about extending offers and changing terms, so they've been really, really good. I would generally say if you can apply, do it. And then same sort of thing happens here. So let's say, for example, you're still 6-12 months away from completion. If a better product comes up, all we'll do is ditch that application, go with another bank. But I would always urge you to secure something now, because I don't want to be pessimistic, but let's say we do have a second spike and we go back into lockdown again. Just secure terms you can now, because you can always improve them later. But once they're secured, they're secured. So I really would urge you to do that. Lillian, you've asked, as a first-time buyer, are there still 5% deposits? So yeah, absolutely. So you can buy with a 5% deposit up to £500,000. that still works. Again, depending on your circumstance, but in market terms, that's what's possible. Siobhan, you've asked, looking to do a joint borrower sole proprietor mortgage with my partner. He has a property, but I am a first-time buyer. Will I still get the first-time buyer allowance? Also, Skipton. So let me answer the first part. Yeah, that's a great. Now, yeah, I'm not giving you tax advice. If anyone from HMRC is on the call, I'm not giving you tax advice. I certainly wouldn't do that anyway. But yes, it's if you've got someone who owns a property and one person who doesn't own a property, a really good way round to mitigate stamp duty is just to have the person who doesn't own a property on the property deeds and have the second person on the mortgage. Now, you mentioned the specific name that's called joint purchaser sole proprietor, or you can do a guarantor mortgage as well. Yes, that does work, and quite a few banks do allow that. You've also put Skipton state the other borrower can't live in the property. Is that true for all of the banks? So no, that's specific to Skipton. Some other banks do allow. So the majority of banks take that stance, but not all banks do. But you're quite right, that is Skipton's policy, absolutely. Cool. No problem. So if you could say thank you for the questions, that's all cool. Right, so I think, unless there's any more questions, we'll wrap that up. Okay, cool. I think we're done there. So like I said, I'll send the follow-up through. Look out for that. If any of you need any help, you've obviously got my details. All of the guys' contact details are on the website. Feel free to get in touch. And yeah, we'd love to help you out at some point soon. So have a good long weekend and hope to catch up with you guys soon. Thanks a lot. Bye.